My name is Mijanur Rahman, and this is the video number 10 on financial planning Tacit knowledge series. Today, what I'm going to talk about is slightly different approach that I'm going to take, but let's recapture from the previous video. So we talked about the cash flow, right? Now I know that I haven't gone to the in-depth analysis of cash flow of the for the purpose of businesses and business owners. So that is something that I will talk about it sometimes later in a different series or a different video series that I'm going to talk about for the high net worth client, how to do the planning for them, and what to expect and what not to expect. So that is something that we'll talk about later, but by now you do have some idea about the why cash flow is very important to sustain any type of investment planning, right? It is very important, right? And again, it allows you to increase your cash flow or return within the existing plan without investing, right? Because you're getting a return just simply re-engineering your cash flow, right? So that's something that you'd have to look into it. So let's recapture. So we talked a bit about mutual funds, a bit about segregated funds, a bit about ETF. Now, ETF is not so different than the mutual funds and segregated funds. The only thing is that it contains slightly higher risk than the other ones because of the diversification. However, if you're building a portfolio within the ETF, often you could mitigate that risk, right? So that is something that you would have to work it with your financial planner or your investment advisor, whoever you're working with. So this is something that I won't get into too much discussion of it here because it will be redundancy of the discussion. It is very similar in nature, so please feel free to talk to your advisor. So today I'm going to talk about a bit about stock and options and derivatives, not to the extent that these are something that will give you some indication what to look for, and this video is only educational purpose. So it's slightly different approach that I'm taking within the accounting scope and financial planning scope and investing scope, right? So legal scope a bit. I'm not expert on a legal, so please do not take this in any content from this video and use it for the purpose of investing, for the purpose of planning. Please be sure to talk to your advisor or your planner, okay? So, or your legal counselor. This is to give you some sort of idea about the market. Again, I'm not getting into in-depth analysis because it is quite impossible, because I don't know your situation. I don't know your cash flow. I know nothing about you if you're watching this video. So this provides only general guideline. So what is a stock? A stock is an ownership, right? So when you buy a stock, you buy ownership, and when you buy bond, you buy debt, right? So let's say if you're going to a bank, and the bank issues you a loan, so they just sold you a debt, right? So you bought the debt, and in return, they get interest income on that. So this is something, the bond is quite different than a loan, right? This is to give an example, so to simplify the aspect. So what is bond? There are two types of bond. A is a premium bond, and B it's discount bond. Often you'll find in zero interest bearing bond, right? So a bond has a coupon rate, right? And the coupon rate is something that is a stated rate. That is, when you buy the bond, it will tell you that. So let's say, what is a discount bond? A discount bond is something that you buy at a discounted price. So for some reason, it could be the interest rate they're offering it. So because of that, they probably discounted the rate. So I'm not going to get you that how to value the discount bond or the nature of the discount bond or the premium bond. So beware of that, is that you're paying a discount bond, you're paying a lower price, and that's why they call it discount bond. And the reason it could be because of the interest rate, right? And the same thing in a premium bond. It is you're paying a higher premium because it probably offers you a higher coupon rate, right? So the discount bond provides you a lower coupon rate that are available from the market rate or some sort of standard market rate they use, right? So this is something that you need to look into it, right? Often it's a complex product, and so that's why I'm not going to get into in-depth analysis. So be aware of that. The main concept when you're buying a discount bond, you're buying at a discounted price. So, and also if you're a corporation, if you're buying this from the business, so the business has to do the accounting method. They have to make sure that if you're a business owner, if you're investing this from the business, often you might have an OpCo, right? You could use that OpCo to invest it, but it's not a good idea to use an OpCo to invest into the market. So often it's a good idea to have a holding company, a trust, or some sort of secondary segregated company that allows you. So you could, I'm not going to get into the maybe I shouldn't get into the in-depth analysis of it because it could, provide you some sort of complexity. But this is something that the structure of the company. So let's say, you could restructure if you're assuming at some point in your life you will become very successful, and you could restructure your company, your OpCo, and you could have the shares of the OpCo is held through a holding company and through a trust, right? Or it could be processed through a trust and then filter into a holding company, right? So that's something that you aware of. So be aware of that the tax law on this trust, right? So if you're putting money into the trust, and the trusts are subject to tax each year, and the annual return on a 90-day basis, right? So from the year end. So that is something that from the fiscal year end, so you have 90 days from that to submit the tax return on the trust. So that is something that you have to take a look into it. Before I even get to that, the aspect of the investing under the holding company, I just want to give you some idea that, what can you do with it, right? So if you're a business owner, you're listening, this is not, I'm preparing for you, okay? This is something for someone who is actually investing in the market, and someone is an average earner, right? So if you are an individual who is a business owner and fall into this third tax bracket or second tax bracket, and you don't have sufficient liquidity, sufficient retained earning within the OpCo, you may not need to proceed with the restructuring of the company, right? So that's something only for the high net worth. So let's say someone has, in the company retained earning over $500,000 or probably, a couple of $100,000 sitting there doing nothing. So they could, or probably, they have the potential to become larger. Could be billion, they could have a $30 million of the retained earnings, could be 100 million, could be $1 billion. Right, so that's something that, and again, as the value of the OpCo, and you will see, and of the company that I do want to mention that often you'd see in a financial industry that there's a laddering, right? So the structure of the company, this is how they work, is that they have a ladder system, and it's like a pyramid-shaped ladder, right? So as you can see, you'll have various OpCo, and it's one. So the perfect example would be, I don't want to be neutral. I don't want to take a name of a company, but you could search. There is one company, and they're actually into the insurance industry, and they have a setup of various layers. So they own various financial companies throughout the subsidiary concept. And often it could be controlling interest, often it could be significant, often it could be any other method. But take a look at that, right? Often it could be wholly owned. So take a look at that. So often you would find in the banking industry too, they own, there might be a holding company that owns various corporations, right? So those corporations could be OPCO, right? The size. Just want to give you some idea, right? So you know what is that, how to structure if you're if you're doing very well and if you're listening to this video. So let's get back to our bond, right? So that is something that so we know there is a premium bond and there is a discount bond. Discount bonds are purchased at a discounted price because of the lower coupon rate, and premium bond is purchased at a higher price because of the higher coupon rate. Now, because of the bond, because bonds are interest sensitive, right? Bonds, every bond is interest sensitive. Now, your coupon price may not change, but the face value of your bond will change because of the effective market rate, right? And that's something that if you're, for example, if you hold a 10 years bond and down the road, at the time when the valuation took place, the market price was, market interest rate was 6%, and 5 years down the road, and the interest rate went down to 3% or 4%, right? So the market interest rate. So that's something that affects the face value of the bond, right? So same concept applies to the premium bond. So both bonds have a very similar nature. The only thing you need to consider, and again, beware of that. When you're buying a premium bond, you paid a price for it, right? So basically, the difference on the premium that you paid is actually it's getting paid out over the life of the bond to you, okay? So those are spread out over the years. So something that you need to be aware of, something that you need to know, okay? So when you're buying a bond, don't just assume that it's a discount, it's not a good bond, it's a premium, it's a great bond. There's no such thing, okay? So you'll be able to understand whether the company who is issuing the debt, whether they have the ability to pay out the bond. Often bondholders are preferring when it comes to in the event if the corporation has to declare Chapter 11 or go to bankrupt, right? So bondholders has certain rights and a certain preference over the other creditor to be paid. So if, let's say, for example, any case, a corporation has to dismantle or go bankrupt. In this case, the bondholders are preferred, right, when it comes to payout. Obviously, you'll be paid at a liquidated value, so beware of that. So when you do buy a bond, again, over and over and over again, it's coming back to the financial statements of that particular company, financial life, managing mind behind that particular corporation. So again, if you look at that, the underlying value in this case is not derivatives, but the underlying value is from the financial statements, right? So be sure to analyze the financial statement very well. Be sure to understand the company very well. Be sure to understand the management analysis and discussion, where they want to go, and from what's their mission and vision looks like, where they want to be, who is the mastermind behind that, where they want to go. Do they, so let's say, for example, if you are investing into a company that is, let's assume that's operating right now in Canada, and let's assume that it's a natural resource company, and it has no intention to diversify its portfolio outside of this existing buyer. So let's say, for example, if you're investing into an XYZ company, and the company produces a lot of log, and they're fully dependent on neighbor countries, right? And the problem with that is that they are not getting a big bucks for their inventory, right? So this is an inventory-based business, right? Often contract-based. So this is a company that they take, contracts. They buy, they sell contracts and they produce log, right? So something that, again, over and over, that if you take a look at that company, what their intention looks like, right? Whether they have existing contracts, right? And what's happening with that? There's a various aspect. I can't get into the enough discussion of it because of you need to read the non-disclosure of that particular company, right? What's their mission and vision looks like? And do they have a contract that's actually dying out? They cannot pay out. They cannot. So let's have an example. If you bought You bought a lot, you bought something from a company. They produce natural resources like log, and they promise to deliver a contract, but they fail to do that, right? Look at the consequences of that, right? So this is something that you need to look into it. So let's say, and also look at the consequences of the accounting statements. What's happening? Are they really, whether there's a financial shenanigans that is taking place, right? Are they inflating or deflating their income? They're inflating or deflating their expenses, right? Take a look at that. Are they, these are something that you need to look at it, right? This is accounting. You need to understand accounting very well, right? To service your client, right? So, if you're an investment advisor, if you have no knowledge on the accounting, that could be really difficult for you to grasp obviously, you are prohibited from having insider knowledge, but you're permitted to analyze the financial statements, right? So you're permitted to see what's in the note disclosure, right? At the same time, the company you're buying the options, derivatives, stocks, whatever you're buying them from, right? They have to disclose every aspect. So if you're buying a stock X, Y, and Z, that particular company has to disclose everything in a very short form, and as within the note disclosure. And again, under the IFRS, they're very strong about note disclosure rather than the number, because the number really doesn't tell much. But if you read the note disclosure of that particular company, it tells you a whole lot about it. So there might be an issue with, so let's have an example, they're expanding to another country. Let's, for example, they could expand to another country that they have a tremendous amount of natural resources, right? It could be mining industry. Think, and rather than thinking in the box, think outside the box. So often, if you're given a multiple choice, the answers are A, B, C, and look for the option D, right? What are the options in this case? Look at the option whether this particular company, because often we don't really focus on the issues that they. So let's say, for example, we see the financial statement from this company. They're doing great, but they're not expanding, right? Because without the expansion, there is no growth. So you have to continuously expand. And that's why if you see multi-billion dollar company, they continuously expand, right? They continuously source for a new market niche or new market, right? So they, again, look at the trend, what they're doing. What's their vision for next 30 years, right? Next 10 years, next 5 years, right? So if this company is not diversifying their buyers to Asia, where if you look at it, research suggests that within the next 20 years or so, we'll have the most middle-class people will be arriving from actually Asia, right? And the population growth. Take a look at the population in Asia, right? Is this company is expanding to Asia? What's happening? Are they taking their nesting? Are they taking a cut of their? Are they taking any parts? Are they participating anywhere in that particular area? What are they diversifying their purchaser or suppliers or buyers worldwide? Because now globalization brought the economy into a microscope, right? So you could really put it under a microscope and see what's really happening. And thanks to globalization, and because of that, there are companies that are doing extremely well. And think about, again, I didn't want to take a name, but think about our auto industry. What happened to that? Okay, where did they go? They expanded their business to Asia. Okay, and did they recover? Yeah. So that's one of the. I don't want to take any particular name, so I want it to be as neutral as possible, right? So so this is something that you need to take a look at it. Go by the industry, take a look at it. See what's happening within that particular industry, right? And then again, overall, but go back and forth, see what's happening with the financial statement, what's happening with note disclosure, whether there's a policy changes, right? You have to look into it. What I want to talk about is that so you know what a stock is, right? I don't have to explain. It's an ownership that you're buying on an equity, right? So each company, if you look at the financial statements, if you're buying a stock from company XYZ on the financial statement, on the balance sheet, on the balance sheet, they would have a note disclosure where they would say that you are probably on the balance sheet on the equity section. It will say this company is authorized to issue this amount of shares. So let's say it could be 10 million shares, right? And they have outstanding shares. Let's assume that they sold or the exercise from that is roughly about 5 million or 6 million or 7 million. They have this, shares they could issue, right? Now go back and see the book value of that shares, right? And look at the market value of the shares, the stock price, the stock market value. One of the very method they use is dividend growth model. Right? That's one way. There are other ways. I'm not going to get into the valuation method of the stock. So that is something that you would have to talk to investment advisor. This video only provides general and basic knowledge about investment planning, right? And that's why I'm not going to get into any definition, any structure, rather talk about the planning scope. Okay, so this is something that you need to talk to your financial advisor, financial planner, investment advisor, whatever they call, financial consultant, whatever they call themselves, right? Or securities specialist, whatever it is. So you need to be able to look into it, and your investment advisor has to understand accounting very, very well. All right, because of the obviously you will see that as you go along later on, a big chunk in a corporation, in a publicly traded corporation, is investments, right? There's a different category of investments, right? As you can see, if you look at my portfolio, right? So the same concept they could apply for the investments, right? They could have an investment for held for trading, held for available for sale, held for trading, and held for maturity, right? Often these concepts are used in a bond, but rather I want to give you an idea is that this is something that they also have a category of the held for trading investment, right? Held for available for sale, available for held for maturity, right? They want to hold that for a long term, so held for maturity could be a long-term investment, right? Especially often used in bond industry, that they want to hold that for a very long time, or they want to hold that till maturity, right? And there some of the investment they will see that they held for trading, right? This is something that you need to look into it. Obviously, as an individual investor, so you do not need to get into all this detail of this, but if you're listening to this as an investment advisor or financial planner, be aware of that. Understand the accounting scope. So let's say, for example, take a look at it. If a company is selling a stock, or if you buy back their stock, how they did the accounting valuation on that. Sorry, accounting calculation on that, or journal entry, right? Take a look at that. Find out. I'm not a big fan of journal entry, but something that you would have to look into it. So let's say, for example, where they put that, right? So let's say if a company that buy back some shares from the market, right? Why did they calculate? What did that fund came from, and which account they used, right? So this is something often there's a financial shenanigan takes place right here too. Take a look at that, okay? That's something that allows you to understand what's happening with the financial statements, right? Options. Let's say if you're buying an options, take a look at the options, how they do the with the companies, because of the changing, right? Often the accounting, they forget there might be some sort of error, right? When did the valuation on the investment, they probably forget and left with the gap that they had it before, right? Now it's no longer GAAP, it's actually IFRS. It's old news, but it's trying to remind you over and over again. But so this is something that you need to take a look at it. So if they're following the IFRS, on that case, if they're, let's say, for example, if they sold, and if it is an investment company, if they sold options, right? If it is a financial firm, if they sold, they're doing business publicly, right? How they sold that options, right? That option has a writer, right? So you call options, put options, you buy, it has a writer, right? So financial industry writes that, often investment dealer, right? So take a look at that, okay? So be aware of the entire, it's very difficult to talk about investment planning, but this is something that you have to learn. You spend about 4 or 5 years, that's not even enough. right? So you learn all this time, and this is very difficult to explain in one, in a 30 minutes video, or 10 minutes video, or half an hour video, or over a series. This is something they go through a very extensive learning process. So what I want to talk about is that let's go back to our derivatives. So what is a derivative? So derivatives are actually often options, contracts, forwards, and that could be others, warrants, sweeteners, something that actually often convertible bonds, right? So this is something could be a derivatives, right? Something the value of the product's underlying asset drives from an underlying asset. So let's say, for example, if you buy a contract, right? So what is options? Option is that the value of a contract that derives from something on something else, an underlying asset. So let's say if you're buying a canola, if you buy a canola oil, right, you could buy a contract for that, and the contract is trading on the market, right? But that particular option, so has the underlying asset is the canola itself, right? Could be there is a contract that, hey, they need to produce this much amount of canola, right? Someone bought it. So let's for example, person A or person B. Let's say person A went to a farmer. Let's call it farmer P. So a buyer A went to farmer P and bought a contract, and the contract it's open under contract that can be traded on the market, right? So now, as a buyer, so I bought from that farmer that they have to produce about 100 tons of canola, right? Or corn, something like that, right? So I bought, and they have to deliver that with a 6 months time period, right? So the contract has a time period, validity, so there has an intention. So the contract has an intention, right? As a buyer, I had the intention to execute a contract. The execution takes place with the farmer, right? And there was an offer, right, and so forth. This is the contractual obligation with the contract itself. There's a time limit, and there's a frustration on the time limit, right? So that's something that you have to take a look at it. I'm not going to get into a very detailed analysis of that. Rather, be very simple. So company A, so if person A bought a contract from person B, and they decided to trade it on the market, right? So now let's call that a contract of call options, right? So in an option, there's two types. There's a put option, there's a call options, right? And that let's assume that the person A now went to the contract. Let's call a contract. Let's give it a name. Let's call it canola options, canola call options, whatever it is. So now he went and now someone actually had to write a contract before they actually trade on the market. Someone to write that contract, right? That's a call option or put options, right? So now that contract will be traded on the market, right? Just to give you a basic idea, and based on the nature of the contract. So let's say, for example, now the option writers could decide whether they could write a call option or put option, right? So they could decide whether they could write a call option or put options. What is a call option? The call option is something that let's assume that the underlying value derives from something else, and the buyer of the contract has a strike price. So the buyer believes the market price for that particular underlying asset will go up, and they believe. So they said that, okay, in a call option there is a strike price. So let's say, as a buyer, I could buy a call options at $20, and I suggested there is a strike price there, right? So the strike price could be, let's say I have a strike price. I bought a call options for call for 20. There's a strike price for, let's say, it's $21, right? So now I know this is my $21 is my strike price, And in any event, if the market goes up to $26 in the next 6 months or next whatever time I left when I bought that, whatever time left, not I, someone else, whoever bought that, they have a time limit, right? So let's say it could be 6 months, it could be 3 months, whatever the time left on the actual contract, right? So now, now what's happening is that so now the market went up 3 months down the road, right? And the buyer of that call option, they exercised that price at $21. So they assume that the price went up to $25, and now they're at $4 profit, right? Now don't forget, don't forget to substitute, if you're doing the accounting, don't forget to substitute the option price that he had to pay for it, right? Because option is a right, but not an obligation, right? So now that he exercised that right, so now he has to account for it. So make sure that when the accounting is done, if it is a corporation, then you have to do the accounting. But if it is an average person, then you do not have to do the accounting for this, right? The same concept for the put options is that if you're buying a put options from a market, put options simply means is that they has a right to sell rather than right to buy. So it's right to sell, but not obligation. Excuse me. So let's assume the same contract, the option writer is and went to the market. He said, okay, you know what? We're going to sell that contract. You place the contract in the market. Now there's a bidding place, right? So someone believes that the market price for that particular underlying asset. In this case, the canola. In our case, it was canola or corn. So the price could drop, right? So if the strike price in this case was $21, and in this case, the market value, the market price is going on. Let's say, for example, let's say the market price is $22, and the strike price in this case is $19, right? And the reason they're buying that strike, the put option, they believe instead of the market going up, the market will fall, right? So that they don't have to. These are the strategies that increase the stop loss, right? So often they use that for the stop loss, so they could so they don't have to. They don't have to go under any more loss than the $19. That's why this loss is. So let's assume the market falls to $19 and or $18. At $19, there's no value, right? So let's assume the market fall to $17, or market fall to $15, right? Or $14, or $10, whatever it is, right? The difference is actually so now the buyer of the options, right? They don't, they could either they have the right to exercise, or they could sell the option to someone else, right? So in this case, they often, as a fund managers, often as institutional investors, often as investors, they use the put options or call options for hedging purpose, right? The futures, right? Often they use it for hedging purpose. What is future? Future, same thing, but it doesn't trade often in the market. Future is a contract where there's a long and there's a short, right? So there's two sides, right? So that is something that you'd have to take a look at it. The idea is that they're all very similar in nature. The concept of derivatives is that the value of the products, the value of the contracts derives from something else. So basically, you are not actually selling them. You're not buying them. You are not buying the product, but you are buying a right. Okay, but beware of the contract holder, right? Let's assume that let's assume this person who actually bought the contract and did not trade on the market as an option. Now he's obligated to take the delivery. And the same person, the person P, the farmer, has to deliver the product within 6 months, right? This to give an example, right? This is something beware of, that there is a legal scope of it. So the legal scope of that is that what you want to know is that there has to be intention to have a contract. There has to have an offer. In this case, it would be bidding if you're trading that option in the market. So let's assume this is option. So the intention for the option is illegal. This is how it's legally binded, is that you have an intention to sell that offer, buy or sell, right? And the offer is taking place through the bidding, and then acceptance of the bidding, and the consideration, right? Consideration is that you provided someone actually bid it and accepted and they paid the money for it. And once they bought that option, they have a time limit. So if the option it's not on the money. If the option is not on the money, what it means that it didn't benefit you, and you let it expire. So then it becomes a frustration. The contract is dissolved by itself, right? So let's, for example, after the 6 months, the contract, the timeline finished, and the contract finished, and the contract will also dissolve. But this doesn't take place in real life, but it often, for example, you put an option, the option is not on the money, and it never was in the money, so the contract is simply dissolved just by the frustration itself. So this is something that you need to take a look into it. The same concept that applies, call options, put options, the same concept that apply. Warrant and convertible debts that I want to talk about it. What is a convertible debt? So let's say, for example, if you buy a bond from a company, they might say, to attract the client, they might say, okay, if you at some point you could change it to preferred shares, right? So let's say, for example, if the company is doing extremely well, the company, as a buyer of the bond, you have the ability to participate into the upside of the market, right? So if the company is doing very well, this allows the bondholder to redeem his bond and buy preferred shares or some certain common shares even at a different at a suggested price. So beware of those, that the price would be written there on a convertible debts or convertible bonds. So let's say, for example, at what price, there would be a stated price, right? At a stated rate, it could be, let's say, they have a rate. Let's say, for example, one person has a bond, $1,000 bond of a company, and they're saying is that the company who's selling the bond or issuing the bond is suggesting is that this bond can be traded or converted into preferred shares or common shares at $20 at a stock within this particular time range. So there might be a time range, there might be different scope of it. So take a look at that scope and see how that affects you. And be sure to read the accounting. If you're investing under the corporation, you have to take the accounting and you have to follow. If your company is publicly traded and it's a very small company or mid-sized company, then you have to follow PE GAAP. And if it is an investment firms or institutionalized investment who is trading on the financial market as a publicly traded company, in this case they have to follow the IFRS. If so, follow the investment accounting and how the accounting method takes place. So let's, for example, to give an example idea, call options, right? If the call option in the money, there is unrealized gain, they have to record it under the IFRS, right? So that's something that you would have to look at it, and again, see what's, look at what type of financial shenanigan that takes place within the unrealized gain, okay? So that's something that you'd have to look at it, right? So, call options is not exercised, but there is unrealized gain, right? They could potentially sell, right? So that's something that you'd have to look at it. And again, if you're buying a stock from a publicly traded company, it is highly unlikely they do the tax. They would have the tendency of maximizing the revenue, okay, and rather than minimizing the expenses, right? So often they have the tendency, because they want to profit, maximize their idea. They actually work for the shareholders. They want to actually maximize their value of the stock, right? So often the valuation of the stock comes from the earnings, right? So if they try to maximize the revenue source or maximize the revenue recognition, that's something that will allow them to participate at a higher stock price, right? So if they could provide a better stock price for stockholder or shareholders that provides them a creditation, a better, I don't know if that's the word, better credit that their effective management. So take a look at the financial shenanigans, right? So that's something that you would have to read, you'd have to understand, right? Often, let's say for example, we all know about Enron, right? So this is something that I prefer not to talk about it, but this is something that we know all about .com, right? We know this is all these are all victim of the financial shenanigans, right? We know the Arthur Anderson, I think. Naming the company correctly, the accounting firm, right? We know there is, we know what happened in 2009. We know what happened in 2009 in the financial market, right? Take a look at it, right? These are all because of the, not all because of the financial